Remember, our goal is to generalize on 31st of December. Okay, what's going on? Okay, so the business has interest expense of 1200 that it must pay early in 2015. So you are here on 31st of December. So what is the entry? So did you pay that? No. Interest expense occurred? Yes. But paid in the same year? No. So you create liability. Interest expense to interest payable. Okay. Okay. And then the unadjusting balance of the supplies account 3200. The total cost of supplies in hand 1500. So how many you consumed? 3200 was at the start of the year the balance, and left 15. So how much you have consumed? So 3500 minus 1500, 2000. So what is the entry? Expense to supplies. Supplies expense to, not two, okay, sorry, not 35. Okay, I just mismanaged. 3200 minus 1500 is 1700. I made a mistake here in calculations. Not 2000, it is 1700. Okay. Supplies expense to supplies. Supplies are assets. Asset decrease, credit. Supply expense increase, debit. Okay, guys. C part. The salary expense is paid $3,000 per day. Remember? So Monday through Friday, which means on 5 days they are working. So the business pay employees each Friday. So they pay cash to employees, 5 days salaries on each Friday. But this time the 31st of December falls on Wednesday. So Monday, Tuesday, Wednesday, this belongs to 31st of December 2014. And Thursday and Friday, it belongs to 2015 January. Okay, so it means these 3 days salary will be, it belongs to 2014. All right, but did they pay it? No, they will pay on Friday. So 3 days salary, 7,000 multiplied by 3, which is 2100, belongs to 31st of December 2014. So did they pay it? No, you create liability. So this is accrued expense. Salary expense to salary payable. Any question, guys? Please participate. Any question?
No, sir, not right now.
Okay.
No.
Good. Now D part. On July 1st, 2014, when the business collected 15,000 rent in advance, so business collected 15,000 rent on advance, which means this is revenue. Which revenue specifically? In advance. So we call this, some books call this advance revenue, some books call it, like right now what we have learned, unearned revenue. Okay, in advance. So it debited cash, so they make the entry cash to unearned revenue. So the tenant was paying for the 1 year rent. So 15,000 divided by 12, how much? For 1 month? Let's see that. For 1 month, wait a second, 15,000 divided by 12 is 1250 a month. Okay, so how much they have earned? Multiply by 6. 7,500, or How many months have passed? July, August, September, October, November, and December, 6 months. So half of the revenue is entitled on 2014. So what is the adjustment entry? Liability decrease, sales increase. So liability decrease mean debit. So unearned revenue to revenue. So which revenue? Rent revenue. So unearned rent revenue to rent revenue. So this will go to balance sheet. So this will go to income statement, and this will go to balance sheet. Decreasing the liabilities, and this will increasing the sales. Understand, guys?
Yes.
Interest revenue. So pay close attention. Interest revenue, which means they are collecting. 900 has been earned but not yet been received. Accrued revenue. So did they receive cash? No. So it means they create customer. So here, account receivable to interest revenue or revenue. So account receivable. So they just added interest receivable because they're selling rental services and also services for interest. So two services. So they are segregating interest revenue versus rent revenue. Okay, if you even write down the receivable, it's okay. Even if you write down only revenue, it is also okay. All right, so all you have to do, just make the entry here, receivable to revenue. Our F part, equipment was purchased at the beginning of the year at 50,000. The equipment is useful, the equipment's useful life is 5 years. So you divide 5, as there is no residual value. You will not receive anything after the 5 years when you sell it. So it means 10,000 for whole year. And you purchase at the beginning of the year. So it means 10,000 worth of equipment you have been consumed. Right? So what we use the word here for this consumption? Depreciation. And which account you charge it? Accumulated depreciation, which is contra account. So expense increase, yes, depreciation to accumulated depreciation, 10,000. All right. And the question says, what is the book value? Book value is equipment 50,000. This will go to balance sheet as contra account 10,000. Our book value now on the balance sheet will show 40,000. So again, many students are confused why we created accumulated depreciation. In order to know that, because so in a business there is not only just one long-term asset, there are many, like chairs, fixtures, tables, computers, vehicles, right? So now they want to know that how much equipment they purchased. So this shows that 50,000 worth of equipment they purchased. Similarly, on above, maybe chairs, maybe ACs, laptops, vehicles, cars, trucks. So they want to know that how much were their cost value to us. So depreciation, accumulated depreciation is the total depreciation on everything. So this also tells us the meaningful information that how much we have consumed from our total long-term assets. So in this case, we have only one long-term asset, which is equipment. So equipment worth of 50,000 and depreciation on only this one asset is 10,000. Book value is 40,000. Any question? If no more question, then let's construct the financial statement. So we already know what is financial statements. 4 types of financial statement. Number 1, income statement, and then retained earnings statement, and then balance sheet, and then cash flow statement. So we have chronological order here. We also see its linkage. Here we go. So first of all, from the unadjusted trial balance, so where these figures are coming from, you just open the let me show from here. Unadjusted trial balance. So you have unadjusted trial balance, and now you have adjusted trial balance. So all the figures are here. balance sheet item, retained earning item, income statement item, all are here. So you just, rather going to the every T account and finding out the balance, you just open the adjusted trial balance and pick up the relevant account and just paste it over there. So how you create income statement? The revenue versus, okay, let me go back over there directly. So revenue and less all the expenses, and then income tax, income before tax, tax is 600, and then this is, okay, I think this is for, yeah, Friday auto surface. Sorry about that. So remember, what is the link of income statement and retained earning statement? From income statement, we find out income, and income will go to make retained earning. So what is the formula for ending retained earning? We already discussed in our earlier classes. Ending retained earning is equal to opening or beginning plus net income minus dividend. The amount will be here. So similarly, opening, net income, and this dividend. So this will go to balance sheet. So what is the balance sheet formula? First, write down current assets, right? So that retained earning that we calculated, 15,500. So we make the assets, cash. First, write down current assets, cash, accounts receivable, supplies, prepaid expense, and then long-term assets, land, equipment, less accumulated depreciation. So total assets are like this. Liabilities, first current liabilities, and then long-term liabilities. But we don't have any long-term liabilities, so our total liabilities are like this. And stockholder equity, 50,000, and retained earning. This retained earning is coming from retained earning income statement. All right. So our total stockholder equity is this much. This much is total liability. When you add all these, answer going to be 83,300. Okay. So assets is equal to liabilities plus owner's equity. Our equation is also balanced. All right. Now, what we have learned today? Today we have learned to adjust the entries, make the adjusted trial balance, and